dream. I was flying high, I was feeling fine. I won't be put in line, 'cause I'm ready to...
Simply Financial with Christopher Calandra, Certified Financial Planner, is an innovative, comprehensive, informative, and cutting-edge podcast that discusses financial topics ranging from personal finance, economics, politics, and personal growth. Simply Financial will cover intriguing and thought-provoking questions so that the listener can simply increase their financial IQ.
Welcome to the Simply Financial Podcast. I'm your host, Christopher Calandra. This is episode number 38 of season number 3. With me today as my guest is Gwen Bade. She is the branch manager here in Southington, Connecticut, the same town I live in, and the primary office for Elliott Wealth Management Services. She's with Envoy Mortgage, and she started her career in the mortgage industry in 1999. Although, Gwen, we don't exactly want to give away your age, but you did start in the financial services mortgage business in 1999?
Yes, that's correct. Well, I started, earlier than that as a financial advisor for Solomon Smith Barney, and then transitioned into the mortgage industry in 1999.
Beautiful. So I wanted to have you here today because I want to talk about the difference between qualified mortgages and portfolio mortgages, and talk about conventional versus non-conventional. These are some of the terms that people will hear tossed around quite a bit, but I think there's some confusion about that. So first off, I'd like you to just educate us on some of those basics. Then secondly, well, let's do that first, and then I'll get to the second thing. So conventional is a mortgage amount below a certain threshold, is that right?
Yes. So when you have a conventional conforming mortgage, this is a mortgage that is purchased by Fannie Mae. Fannie Mae is a government agency that provides liquidity to the market for banks and mortgage companies. And they have a set of rules that mortgages must comply to be conforming and conventional. Conforming really is just, they set a loan limit each year. Conventional means it's Fannie Mae. FHA is also a government agency that provides liquidity to the market, and they provide liquidity for people who might have a little bit lower FICO scores or less cash available for investment.
Okay.
But both government agencies provide liquidity.
And when you say provide liquidity, if Envoy or any other mortgage company, they underwrite a mortgage, they write the mortgage, they could then sell that to Fannie Mae, and then they get their money back, and that allows that mortgage company to now redeploy that money into a new loan.
That's right. That's sort of how it works. The Fannie Mae is, yes, an investor that will buy. It will provide the liquidity to the banks. It will buy the loans and help them to underwrite new loans.
Okay.
Yeah.
So that's kind of conventional, and then qualified loans are loans that are eligible to be purchased by the government agencies.
Yeah, the CFPB set up a definition for what is a qualified mortgage. A qualified mortgage is, again, a loan that Fannie Mae would accept. And it has a certain debt-to-income ratio of 43%. The FICO score has to be 620 or above. FHA is 580 in most cases. And this is a definition to be a qualified mortgage. So after 2008, after the housing crisis, credit really dried up. So people who had that fit that specific parameter of debt to income, cash reserves, FICO score, they were the only ones that were able to get a mortgage. It was very difficult for people who fell just outside that realm, near misses. It was almost impossible for them to get.
So no extenuating circumstances. If you checked the boxes, you were good.
Yeah.
But if you didn't check even one box, you were unlikely to get a loan.
You were denied credit.
So before the housing crisis, was the criteria for these qualified loans, were they a little bit more loosey-goosey, and then they become more stringent in the aftermath of the Great Recession?
That's exactly what happened. There were all kinds of products. There was, no documents required, no income required. The subprime market was really very, very loose with credit.
And the governmental agencies were providing liquidity and buying those types of mortgages in many instances before the financial crisis.
No, the government agencies still had their own criteria. This was a separate, non-qualified subprime market that just went very, very loose on credit.
But here's what I'm not clear about. Prior to the financial crisis, did you have the same criteria for qualified mortgages, or has it become more strict in the aftermath of the housing crisis?
What happened is subprime went away. The Fannie Mae and FHA, they didn't change. They always existed.
So it's the same
post.
criteria. So the 620 you mentioned a moment ago, the 580, that hasn't changed.
That hasn't changed, but the ability for people who don't fit those strict parameters to get a loan went away post 2008. So banks slowly started to say, well, we have some people who have very good credit, who are a very good risk, that don't fall within those parameters of the investors. Why don't we try and help that segment of the market?
Right. So today, because what I was going to say, I started to tee up the second thing. I think you're a little ahead of me. But the thing that's really bothered me over the course of my career is that banks are incredibly difficult to deal with. Mortgage companies are incredibly difficult to deal with if you don't check all of their boxes, any extenuating circumstances, and then your ability to borrow mortgages, but even business loans and personal loans and stuff like that becomes incredibly difficult because the government is kind of one size fits all. And if you fall outside of that, it's hard to get credit. And I get that before the financial crisis, these other programs were way too liberal. There was too little underwriting, and it got out of hand, and it contributed to the mess the country ended up in. But in the aftermath of the housing crisis, it's almost like the pendulum swung the other way, where in my mind, Gwen, before the financial crisis, people got loans that they didn't have any business getting because of lack of income, lack of credit, lack of equity, lack of down payment, all of those things. They were just bad loans. But after the financial crisis, it seemed like loans that should legitimately have gotten written weren't getting written on any terms simply because, like you said, there was no market, no appetite for that, and a lot of people were locked out of the marketplace. I know for myself, Gwen, I have lots of clients that, a good friend of mine, actually, I was with him before you and I sat down this morning. I remember him saying that he had 10 successful loans with a local bank here in Connecticut where he borrowed money and paid it back. And then they shut down his line of credit because even though he had a big investment portfolio, he lives in a $700,000 house with no mortgage, and he has a successful business, because he didn't check the box on the debt-to-income ratio, they took away his line of credit. Even though he was an exemplary client of that financial institution, they just shut him down. And I think that's what you're talking about, right? We're talking about the same thing.
Yeah, so what I'm here to talk about today are some specific products. I'd like to talk about the Business Bank Deposit Program and the Asset Utilization Program. And these are products that fill that need. Where a man who might have a successful business, or a woman that has a successful business that has bank deposits of over $1 million each year with very good credit, and like you said, they might have another home that has no mortgage. Why shouldn't they be able to access credit?
So, because that's what I wanted to have you on, because in our discussions, because we worked together on a mutual case, a client of mine who was looking for a mortgage, we worked on it together, is that what I've come to realize that since the financial crisis is that there are some innovative offerings that your company has, and maybe others in the marketplace, but specifically Envoy Mortgage, that addresses some of these deficiencies. There's a need in the market where certain high quality people in situations that don't narrowly fit into the qualified governmental agency checklist, they're good credit risk, and they now have some options with you. And I wanted to share with these, and they're broadly considered what? Non-qualified mortgage opportunities?
That's right, and that's also synonymous with portfolio loans.
Okay.
So the banks have decided that, just to reiterate, that if there's someone who is of a high credit quality, who has sufficient cash reserves, or whatever criteria they set, that they will extend credit. So, for example, with a business bank deposit program, I'll give you a hypothetical example. Let's say we have an electrician. And let's say this electrician has $1.5 million in revenue each year.
In his business.
In his business deposits, not personal. But let's say he takes little or no W-2 income from the business.
Because he might be reinvesting it back in the business. He might be in growth mode. Okay, I'm with you.
Exactly. And let's say on his tax returns, he shows very little distributed to him as well. So his income on his tax return could be very low. So let's say under qualified means, this person shows enough income to qualify for $200,000. So this person, under a bank deposit program, if they have a high FICO, let's say 700 to 740 or above.
Okay.
They have sufficient cash reserves. Some of these programs would require 12-month cash reserves. And what that means is, after everything is said and done, the borrower would have to have monthly principal, interest, taxes, and insurance left over in their bank account, equaling 12 months.
Okay.
So, for easy math, if it was $1,000 a month, principal, interest, taxes, and insurance, they would need $12,000 left over in the bank after everything's said and done.
So do they end up with two mortgages in that instance? Do they end up with a qualified and a portfolio, or it's just a portfolio?
No, in this hypothetical example, I'm just showing that, let's say, this electrician shows a little bit of income enough to qualify him for a small amount. Well, that person, instead of going, it's not enough to buy the house he wants to buy. So let's say he's identified a house that's $800,000. He wants to put 20% down to avoid private mortgage insurance, and he wants to borrow the difference. Well, under this program, he could qualify.
Okay, but he would only have one mortgage.
He would only have one mortgage.
Okay, and what you guys are underwriting is saying, okay, under the qualified, maybe he doesn't meet the debt-to-income ratio. Mm-hmm. And so that would cancel out his ability to do the qualified mortgage. But this program looks at other factors. And what you're saying is if somebody has money in the bank or liquid assets, you're going to factor that in.
Yes.
And that's the way you'll underwrite them, where the qualified, the governmental mortgage, the mortgages the government would like to buy wouldn't look at any of these factors.
No. So in this case, his $1.5 million in revenue each year would be averaged over 2 years.
You're going to count that, and you're going to look at their assets.
And then we're going to divide that. We're going to say, we're going to assume that 50% of that would go towards gross margin.
Sure.
And the difference we would divide by 24, and we'd get a monthly payment. Now, that monthly payment is going to be a lot larger than what they're showing on their tax returns, or W-2 or 1099.
Right. No, I think that's very good, because for small business owners, and I'm an entrepreneur, and lots of my clients at LA Wealth Management is that, also when you're underwriting for a qualified mortgage, for a small business, they look at a couple of years' worth, right? Mm-hmm. And in business, it's not unusual for you to have some ebbs and flows. You could have one great year and one bad year, and that could knock you out of the box in the qualified mortgage. So these other factors like liquid assets, or it's not really liquid assets, right? It's just gross revenues of the business.
In this case, they would also have
I'm mixing apples and oranges.
Well, no, you're right. You're correct, because they would have to show the business deposits for income to qualify.
Right.
But they would also be required to have assets in reserve.
So you're still going to get them to that 43% debt-to-income ratio, but some of it will be actual